What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we're going to have some fun debunking some more myths about dividend-paying whole life insurance. This video is in response to a comment I received on another video of mine, which I really appreciate. I love when you guys leave comments and feedback, even if we don't disagree. That's totally fine. I think these types of conversations are really productive and important to help us all make an informed decision on whether or not these different financial products are right for us or not. And I just think this is a really productive way to come to that conclusion. So I really appreciate it. I want to read the comment, and then we're going to break down each point. There's like 3 main points that we're going to cover. So I'm going to go ahead and share my screen, and let's have some fun. So shout out to Mike P4869. Thank you for the comment. Really appreciate it. We're going to have some fun with this. So he says, you grossly overpay for life insurance, pay the insurer to borrow against your own money. Then when you die, the insurer keeps the cash. The lost opportunity is giving the insurer your hard-earned money. Okay, not true, but I appreciate it. It sounds a lot like Dave Ramsey, but that's fine. So let's address the first point, grossly overpaying for life insurance. So if we're only talking about the death benefit and none of the other benefits that we get from these policies and how we're able to use them to build wealth, serve as an emergency funds, living benefits, etc. If we're only talking about the death benefit, then you are correct. It is so much more expensive for the same amount of death benefit in a whole life policy than it would be for a term life policy. There's no disagreement there. That's just logic or facts. Okay. What we're not talking about, though, is why we set these policies up, the benefits that we get, which is interesting because the comment that, or the video that he left the comment on, I'm talking about eliminating lost opportunity costs, why I believe whole life insurance policy is the best way to buy a car. You guys should definitely check it out. I'll link it down below. But I want to give you guys an analogy using this exact logic, that statement, grossly overpaying for life insurance. You know what people, so many people do every single day is they grossly overpay for the same 3-bedroom, 2-bathroom, 1,500 square foot living space by buying a house versus renting an apartment. You pay so much more to buy a house because you have the down payment, tens of thousands of dollars, whatever that is, hundreds of thousands of dollars over the course of your lifetime. You have to maintain it as well, property taxes, etc. When you could just get the same exact living space if you rented an apartment and not have to worry about any of that. Now, if I just stop there, that sounds ridiculous, right? Of course it does, because there's a number of different benefits that people get and a number of different reasons why people buy a house. Well, you build equity. Not for one thing, you could pass it on to your kids if you want. Not to mention, it's your space. You can do what you want with it. You can, did I mention? You can access the equity in your property through a home equity line of credit to go build wealth or whatever it is that you want to do. All right. So there's all of these other benefits and reasons why people buy a house versus renting an apartment. So we need to talk about, like, what are we actually getting for our money? What are we doing with the policy? And then the other thing I was going to mention too is like, all the memories that you create with the house, right? So I didn't want to leave that out because I do think that's important. But with these dividend paying whole life insurance policies, we're not buying them for the death benefit. So to say that we're grossly overpaying for life insurance, well, that's not why we're setting it up. That's part of the reason. Not to mention, we add term life insurance on top of the whole life policies, which significantly increases the death benefit. And we do that to avoid mecking the policy, modified endowment contract. If you do that, you lose all the tax advantages. But if I were to tell you guys that down the street at your local bank, they're now offering a savings account that's going to pay you 4% tax-free compound growth for the rest of your life, and you're actually able to use the money for emergencies, wealth building opportunities, etc., without interrupting that compound growth. And it would blossom into a massive income tax-free death benefit passed on to your family if something were to happen to you prematurely. Does that sound pretty good? I think so. That sounds like an amazing savings account, right? It's very similar to, it's kind of exactly what dividend paying whole life insurance is. It's a very efficient savings vehicle that's going to help grow our wealth slowly. 4%, it doesn't sound like much, and it's not in the beginning, but when you give uninterrupted tax-free compound growth enough time, you'd be amazed at what the numbers look like. You can check out my policies. I've gone through the illustrations and the numbers 1,000 times. I'll link that down below, but it's a very good savings vehicle. And it's a great place to store cash and large amounts of capital. I've moved a lot of my money out of the bank because I don't trust the banking system, not to mention my money just sitting in the bank. It's not doing anything for me. In my policies, I can still get access to the majority of the money within the first 30 days of starting the policy, and I'm getting all of these other benefits. So when you hear people say like you're grossly overpaying for life insurance with these policies, they're only talking about the death benefit. They're not giving you they're not talking about the full story. Which let's segue into the next point that he made: paying the insurer to borrow against your own money. Well, you're not. You're okay. Let me clarify. You're borrowing the life insurance company's money, and the cash value, which is the equity in your life insurance contract, you are borrowing against that. But you're borrowing the life insurance company's money. That's why there's an interest cost. But it's a very, very small price to pay to continue to get that uninterrupted tax-free compound growth plus all the other benefits, living benefits, the death benefit, emergency opportunity fund. And we're able to use that money to go and make more money. Like, for example, I'm doing private money lending here very soon. So if I can borrow at 5.5%, which is my current loan rate on my policy, and I can lend it out at 12% plus points, that's a pretty big spread. And I'll do that all day long, every day. And I'm still getting the tax-free compound growth in my policy. And every single year it becomes more and more efficient. That scenario gets more and more profitable. It's a really, really powerful system. So, but here's another analogy for you guys to kind of paint a picture here for you. When I see this, it just doesn't, again, we're not talking about the full picture here. Do you think it's stupid for banks to pay us 1% on savings accounts and then lend it out at 5%? Is that stupid? Because that's what banks do, and they're some of the most profitable institutions in the world. Well, that's all we're doing, except we get far more benefits with our policy. So I'm borrowing at 5.5%. I'm paying, in this analogy, I'm paying the depositor 5.5%, and then I'm being the bank, I'm lending it out at 12% plus points. I'm doing exactly what the bank does. So is the bank stupid? I don't like banks. That's a whole other conversation though. But hopefully you see my point here is it's a cost, a very small cost of doing business. If I tell you guys that I pay $500 a month for one piece of software in my business to help run my business, and I just stop there, okay, that sounds stupid, right? Like, why would you pay $500 a month for one piece of software? But then if I tell you the rest of the story and the reason, like the benefits that I get from paying that $500 per month, if it's making me $10,000 to $20,000 per month, should I continue to pay the $500? Absolutely. The $500 is just a cost of doing business. The interest we pay on our policy loans, it's just a cost of doing business. And to get that tax-free, to keep getting that tax-free compound growth uninterrupted, plus all the other benefits, and we can still build wealth like we normally would, or take care of the emergency, eliminating lost opportunity costs. That's basically what I talked about in this video. Again, I highly recommend that you guys check it out. These policies are fantastic for eliminating lost opportunity costs. All right, so again, I want to make sure that we're telling the whole story here. We're not picking at just one little piece and then of the policies and then stopping there, because there's so much more to the story. And when you hear the full story, now you can make an informed decision on whether or not this makes sense for you. To me, it was a no-brainer once I started to learn how these things work. All right, then the last point that he made is when you die, the insurer keeps the cash. That's not true. So this is the analogy I give whenever I see this, guys, is if you buy a house for $300,000, let's say your house is worth $300,000 and you have a $150,000 mortgage, like you have $150,000 left on your mortgage. How much equity do you have? $150,000. Would you really expect, if you sold your house tomorrow for $300,000, would you expect to get $300,000 plus the $150,000, or would you just keep your equity? You would just keep your equity, right? That scenario would be ridiculous. So it's the same. It's a very similar situation with life insurance. Why would you expect to get the death benefit and the cash value? The cash value is just the equity, the amount that you can borrow against, and it's the amount that you would get if you canceled or surrendered the policy. That's it. That's all it represents. What you actually get, though, is the death benefit, which is what you want, because that's passed on income tax-free to your beneficiaries. And the life insurance company, this is like a different way that we can calculate how the death benefit is calculated. All right. The life insurance company actually gives you your cash value. Not technically, it's not like in the contract or anything, but think about this. The death benefit, how do we calculate the death benefit? It's cash value plus net amount at risk. Okay. Cash value plus net amount at risk equals the death benefit amount on your policy. So to find net amount at risk, that's the amount of risk to the life insurance company. You take your death benefit minus your cash value. So if I have $1 million in my in death benefit in my policy, I have $500,000 in cash value. What's my net amount at risk? It's $500,000. 1 million minus 500,000, $500,000 net amount at risk to the life insurance company. Okay. So when I die, and we look at that equation there, okay, $1 million, we got 500,000. Basically what's going to happen is the life insurance company is going to look at the contract and say, okay, we owe $1 million. He has 500,000 in cash value. So we're going to give that to his beneficiaries. And then we're going to add another $500,000 on top of it because that's our net amount at risk. That will equal the total death benefit that we are obligated to pay out. So technically the beneficiaries receive the cash, the cash value plus whatever the net amount at risk is. Now, again, that's not technically how they do it. The life insurance company doesn't overcomplicate this stuff. They just write the death benefit, a check for the death benefit amount. All right. But if we just start to break these things down, it's pretty easy to see that the cash value is passed on to the beneficiaries plus the net amount at risk. That equals the total death benefit. And because it's a death benefit from life insurance, it's income tax free. So the life insurance company doesn't keep anything. They don't steal anything from you. I'm not really sure where that comes from, but I guess I do. There's a lot of influencers like Dave Ramsey that talk about it, and they don't tell the full story. So I think that was it. There was one other thing that I wanted to mention about borrowing against your cash value and paying interest on it is, in addition to all the reasons why that absolutely makes sense. And I did a full video on that. I'll link it down below. Definitely check that out. Here's the thing too, though, is you're technically you're contributing to the profitability of your own company. Because when you set these policies up with a mutually owned life insurance company, you are a part owner in that company, and you're contributing to its profitability at that point. So, just something to think about. And then that profitability comes back to you in dividends. Now, you're not paying yourself interest or anything like that. But again, just a different way to think about these things, guys. So anyways, I hope that was helpful. I hope that brought some clarity. The last thing that he said, lost opportunity is giving your insurer hard money. Just a quick response to that is, for me, once I understood how these things actually worked, I absolutely want to give my hard-earned money to a company that has never missed a dividend payment in 146 years, is one of the most financially sound companies in the world, some of the best risk management companies in the world. I'd rather give my hard-earned money to them and have them manage it than Wall Street or banks, 100%. And yeah, so just that's my thoughts on it. I hope this was helpful, guys. Please feel free to drop some more comments down below. Any questions that you have, anything you disagree with, I'm totally open to having an open conversation about this stuff. I think it's really productive, and I appreciate it. So if you guys want to also book a call and have a conversation about this, to just see if it's a good fit for you, if a policy makes sense for your goals, I'll have a link down below to my calendar. You can speak with myself or my team, and we'll just see what your goals are, what your current situation is, and see if it's a good fit for you. All right. So either way, hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty Ice is out.